Imagine waking up tomorrow and discovering that someone doubled the amount of money in the world overnight. Not yours, just money. Nothing looks different at first. The coffee costs the same, your salary hasn't changed, but somewhere, quietly, people are already getting richer, and you are already poorer. That's the uncomfortable truth about money printing. It doesn't hit everyone at the same time, and it doesn't hit everyone equally. Right now, this matters more than ever, because over the last 15 years, governments and central banks didn't just print money, they printed unprecedented amounts of it. After 2008, during COVID, and again when inflation started to bite, trillions appeared on balance sheets with a few keystrokes, and we were told it was necessary: emergency support, stability, saving the economy. All of that is partly true, but it's not the whole story.
To understand who wins and who loses, we need to slow this down and follow the money, literally. When a central bank prints money, it doesn't load trucks with cash and spray it across the country. It creates new money digitally and injects it into the financial system, usually through banks, bond markets, large financial institutions. This is the key detail most people miss. The first people who touch new money aren't workers, they aren't savers, they aren't people buying groceries, they are asset holders. Banks receive cheap liquidity, investors borrow at low rates, corporations refinance debt almost for free, governments fund spending without immediately raising taxes. That money then flows into assets, stocks, real estate, bonds, private equity, anything scarce. Prices rise. And here's the quiet trick. When asset prices rise first, the people who already own them get richer before prices everywhere else adjust. This is called the Cantillon effect, but you don't need the name to understand the damage. If you owned stocks in 2020, you watched markets crash, then explode upward. If you owned real estate, you saw prices soar far faster than wages. If you owned nothing, you felt nothing at first. Then came the second wave. Rent went up, food got more expensive, insurance premiums climbed, utilities followed. By the time inflation showed up in everyday life, the wealth transfer had already happened. And here's where the math gets uncomfortable. Inflation isn't just prices going up, it's money losing purchasing power. If prices rise 7% and your salary rises 3%, you didn't fall behind slightly, you lost ground. Every year, that gap compounds.
Now, zoom out. Governments love money printing because it's politically quiet. Raising taxes is loud. Cutting spending is painful. Printing money feels invisible. The cost is delayed and diffused. Inflation doesn't arrive with a bill saying, "This is because of policy decisions made 3 years ago." It just shows up as stress, as anxiety, as the sense that you're running faster and getting nowhere. And the irony is brutal. The same system that claims to protect the economy ends up rewarding leverage and punishing restraint. If you borrowed heavily to buy assets, you benefited from rising prices and cheap debt. If you saved cash and avoided risk, your purchasing power eroded quietly. The responsible choice became the losing one. Publicly, money printing is sold as support for the average person, stimulus checks, low interest rates, economic stability. In reality, most of the money never sits in ordinary hands long enough to change outcomes. It circulates upward into balance sheets, not paychecks. And when inflation finally becomes impossible to ignore, the solution flips. Interest rates go up, which sounds fair until you notice who can absorb higher rates and who can't. Asset-rich institutions adjust, large corporations refinance, governments roll debt, households feel it immediately. Mortgages, credit cards, car loans, student debt. The same people who didn't benefit early now pay the price later. This isn't a conspiracy, it's an incentive problem. The system rewards proximity to capital. The closer you are, the faster money reaches you. The farther away you are, the more diluted it becomes. Over time, this changes behavior. People chase assets instead of productivity. Speculation feels safer than saving. Debt feels necessary just to keep up. And economies slowly shift from building value to managing prices. The long-term risk isn't just inflation, it's trust. Trust that money means something. Trust that effort translates into stability. Trust that the rules aren't quietly tilted. Because once people stop believing that the system works for them, they don't just change investments, they change behavior. They disengage. They take risks they shouldn't, or none at all.
What do these numbers
So here's
mean?
the question
It's also
worth sitting
confusing.
with. If printing money
Our finances
consistently
are
makes
shrinking.
asset owners
Operations
richer
are stalling.
and everyone
We
else
need a new
poorer,
strategy.
and if it's now a permanent tool, not an
Profits are
emergency
climbing
one,
steadily.
what happens to a
Excellent. Let's keep the
society
momentum.
built on money that no longer treats time, work, and value the same way for everyone? And more importantly, if this is how the system works, where exactly do you sit inside it?
Debt shapes our lives, from mortgages to credit cards and student loans. These obligations become central to our financial identity. As you can see, the market has adjusted. We're looking at declines across the board. Let's review the details.